Hi, Phil Weiss of Enterprise Wealth Management here with another Tuesday tip. In this week's Tuesday tip, I'm going to discuss more tax-efficient charitable giving. In fact, I'm going to go over 5 ways that you can make your charitable gifts more tax efficient. The first one centers on your non-cash assets, such as stock. Why am I focusing on these? Well, if you take your appreciated stock and you donate that directly to charity, you get a double benefit in essence. You get the charitable contribution, first of all. But the second thing is you don't pay any taxes on gains. In other words, if I bought a stock for $100 a share, and today it's worth $150, and I'm donating 20 shares, that would mean that I have a $3,000 charitable contribution because my deduction is equal to the fair market value of those shares. I have a $1,000 gain because I only paid $2,000 for those shares, but I don't have to report that gain. I just get the deduction for the $3,000. So by donating appreciated stock, I've avoided the capital gains tax, which could be 15 or 20%, depending upon your income. Could be 0 for some people if your income is very low, but let's assume it's either 15 or 20%. I avoid that tax hit. I get a deduction for the full value of the stock. The second thing is, not every investment that we make is a winner. So if you want to make donations, you can also think about ways that you compare your winners with your losers. If you have a loser and you want to donate, in that case, I would sell the shares, recognize the loss, and then donate the cash. Example, assume that we paid that same $100 a share for the stock, and now it's going to go $75, so you have a $25 per share loss. We sell the shares, we recognize the loss, then we donate the cash. The third thing that we want to think about is the possibility of bunching deductions. In today's world, we have a large standard deduction. And that standard deduction makes it harder and harder for people to itemize, which means you may not even be able to claim your charitable contributions. But if you can bunch your deductions, that can provide a benefit. How so? Let's assume that you had mortgage interest of $12,000. And let's assume that you also had state and local taxes, real estate taxes, you're capped at the $10,000 amount. That gives you $22,000 of deductions. We assume that the standard deduction is about $29,000. That means you're $7,000 short. If you gave $10,000 this year, that would put you at 32. You get a $3,000 tax benefit because the other 22 plus the 10 would put you at 32. That means you get a $3,000 benefit. But if there's a way that you could bunch it, if you want to make, let's say, 2 $10,000 contributions this year, and you could do that by maybe making it at the end of this year, so it encompasses this year and next year all at once. Now you got a $20,000 deduction this year, and you're going to get 22 for the taxes and the interest, plus the 20 for charitable. That gives you 42. That gives you an excess of 13. If I did those 10 each year, I would only get 3,000 each year. So that's a total of 6 versus the 13, so I get an extra 7. You can bunch even more years together, and it works even better. Next, you can tie that in with something called a donor advised fund. If I use a donor advised fund, I can get the full benefit this year, but I can toss the money out over time. So now I can take that same excess contribution that I made this year, and I don't have to give it all out this year. Some out this year, some out next year, some out the year after. Really up to you, but the donor advised fund is a way to stretch that out. And then the last thing, this one only applies if you're at least 70 and a half. I know R&D start at 73. They used to be at 70 and a half, but they haven't changed the rules for what's called the Qualified Charitable Distribution, even though they raised the R&D age. So once you're 70 and a half or more, you can give money directly from your IRA to a charity. Now, you don't get a charitable deduction in this case, but you also don't include the amount of income. So you get a direct benefit because we're not picking up the amount of income, and that's also keeping your income lower for other purposes, things like income for Medicare purposes, potentially income for your medical deduction because it's a percentage of your adjusted gross income, things like that. So qualified charitable contribution has that benefit. The other thing is once you are 73, or if you've already started the required minimum distributions, instead of taking your R&D, you can make a QCD, the Qualified Charitable Distribution, first. You make that distribution first. It counts towards your R&D. Again, you don't have to include that amount of income, and you've satisfied the needs or the requirements to make that R&D. So therefore, you've lowered the tax bill again. So I hope that you find these tips helpful. If you have any questions, you need further clarification on these ways to improve the tax efficiency of your charitable contributions, please feel free to give me a call. Thanks for listening and have a great day.